right, welcome. I'm GB. Thanks for joining us today. Today we're going to talk about false breaks. I'm going to show you a way that you can take a very simple pattern, one that you probably know already and don't probably think a lot of, and turn it into something approaching a trading system, if you like, or definitely something that should be in your trading toolkit. We're going to look at it in a way that we looked at it in a professional dealing environment, and some rules we came up with, and talking about stops and the way to work out when the pattern's a good one and a crap one. We'll look at a few different markets in cryptocurrencies and probably the S&P as well if we get time, if I don't ramble on too much. But first, let me cue an interesting, cool graphic. Cool. Told you it was cool. Hey, now before we get started, if you wouldn't mind subscribing and liking, that lets me know people are watching this and find it useful and all that kind of stuff. So it helps me kind of come up with new ideas as well, if I know that I'm on the right track at the very least. All right, let's get on with it. Today we're talking about the false break. The simple definition of the false break is what? Well, you already know it. It's a very simple chart pattern where a market's either moving upwards, makes a high, moving downwards, makes a low, and tries to test that high, breaks it by a tick or two or three, and then fails to continue. False break. Relatively simple stuff. Interestingly, I thought I didn't do much prep for this one because I thought we'll just go through I wanted to make a point of not doing a lot of prep for this video because I thought we'll just go through a few markets and I'll point out the way to look, or the way we would look at them in the dealing room. And kind of come up with a few ideas for you. But one thing I did do is I took a look inside. I keep this on my desk anyway. This is the Chartered Market Technician exam and textbook. Look how thick that baby is. It's got pretty much everything on technical analysis in it. Doesn't mention false breaks. Interesting. I kind of like that though. It's a good book. And thanks to the people at John Wiley for sending it to me for nothing for some reason. Interesting it didn't mention it, but let me take you back to when I first started thinking more about false breaks as a good trading, I'm not going to say trading system, but at least a significant part of a scalpers, a short-term traders toolkit. I was in the dealing room. We had a room full of new traders. We were going through, at the time we were trading the ASX 200 index. If you're not familiar with that, it's like the Australia's version of the S&P 500. It covers 200 stocks, but is heavily weighted in banks and resource or mining stocks. Now, that makes it a pretty crappy market to trade, to be honest with you. They call it the Widowmaker, and they do so for good reason. It was a crappy market to trade well before electronic trading came in. I traded it back then, and I traded it after what they call the SICOM system, and then just standard electronic system came into trade. And it's always been a very tricky market to trade. There aren't too many traders. In fact, the best traders I know tend to be pulling their hair out from time to time as well, trading that market. So, but we were trading this particular market with this group of new traders. I think there may have been 10 or 15 traders in our training room at the time. And at the end of the day, what I would tend to do with them is sit down and say, they have to go and write out their good trades, bad trades, print out a chart, say got long here, got short there, all that kind of stuff. And I'd sit down with a little bit of paper and go, yep, okay, yeah. We'd talk through the trade and what they thought, what they stuffed up with, what they did well, all that kind of stuff. Part of the learning process for a prop trader. Now, on this particular day, I remember almost very clearly, it was about 10 years ago, so, give me a break. This particular day, we were trading the ASX, as I said, trading the SPY. It was a strong bullish day. Now, markets never move in one line, or very rarely moving one line. They kind of move in waves, right? We know that. But one thing I noticed about this particular day was that it moved in one false break after the other, which I found was really interesting, because I realized that looking at it, you could be selling the false break 1 or 2 ticks above the previous high. I think we're looking at 3 or 5 minute charts at the time. I used to like trading out of 3 minute charts. I think it was 3 or 5, but you could sell those little waves. You could sell 1 or 2 ticks above the high, put in a bid a couple of ticks below, put your stop a couple of ticks above, and you'd make money every single time. Every single trade would be profitable, and there was something like 10 or 12 trades on that particular day. Just market plodding along, sell here. I'll talk about order strategy in a second, or order technique in a second. But if you got that right, you could make money in every single trade. You could be short 10 times in a day in a bull market and make money, 100% strike rate. I thought, all right, that's interesting. Yes, that doesn't happen every day, but it was a really good illustration of how it can happen. And it got me thinking, how do we go about trading these things? So the way we teach, or the way I'd teach new traders in a prop trading environment is to start. I talk about having your own trader's toolkit. Right, as a scalper, as an order flow trader, you have certain things you look out for, certain ways you trade certain setups. Right, some call it setups, I call it toolkit, whatever it is. I call it toolkit because it's the way you go about trading setups. And from that day onwards, the whole idea of the false break became a good part of that. Because in those markets, and in fact, pretty much any market, and I'll show you in a second, they can be exceptionally reliable patterns that you can make, not $1 million sale, a few ticks here and there, but that all adds up. And if you approach it the right way, pardon me, with the right way of thinking, or the right approach, then they can be, you can get a pretty good strike rate out of them. Let me stop rambling for a sec. Let's have a look at a couple of markets here. I've got, I didn't plan what markets we're going to look at. I just opened up one of my screens. We've got Ripple and Ether. Okay, so on the left, we've got the talented Mr. Ripple. Pretty obvious couple of false breaks here. Let me get my little drawing thingy. Alrighty. All right, there's a nice little one there. See that one? There's also a nice little one there, out to there. There's probably a few more, maybe, I don't know, a couple of ones there, that kind of thing. Go back to the pointer, see what happened at the top there. Not really, I don't like that, and I'll talk about that too. We want to talk about the ones that don't work as well. Pardon me. Now, over here on Ether, same thing. Nice little break there, nice little break there. You could even call that, maybe, yeah, why not, of course. Nice one there. Didn't quite make it there. This one didn't work up here. This market just shot up just before I hit record here. The market shot up, started doing its own thing, and didn't make the false, it was a real break, not a false break. So there's a good reason for that. I'll get to that in a second. The reason when the false break works, it works more often when the market's had a chance to pull back, consolidate, make another run up. That's the important part. What we're not looking for is a consolidation right at that high. Let's say we're looking at a break of a high. You don't want to see a market right at the high and then break again. It's a different mindset of the market when that happens. When a market's like that, a lot of people are waiting for that break. They're looking for that break, and they'll be entering the market right when that break happens. It's a bit different when the market's kind of hit a level, or created a level, I should say, traded up, come back down, and consolidated well below. Because you've got a lot of the short-term traders that are already out, already doing other things, all of that kind of stuff. When the market, they may be waiting for that next break, the next push upwards, and they're getting long down at the bottom of that little range. Let's say we're looking at this one here. I hope you're not looking at this on a mobile phone, because you won't see this so well, but I'll try to explain it the best I can nevertheless. So let's say we're looking at this move here. The markets come up here. Short-term traders are probably out at this red bar here, and consolidating. As this market starts to move up well below that high, you got a lot of these swing traders, a lot of these more short-term traders, the 3-minute chart traders, getting long, waiting for this break, or anticipating, or expecting, maybe hoping for that kind of thing. at least looking at that level, saying, well, market's going to push to that level at least. Markets do tend to push to these levels. Pardon me. And it's no coincidence. That's what they do. Markets are pushed towards levels. Algos do that. Traders do that. It's just a thing that's happened since markets existed. Markets do push towards levels. They act as magnets. Now, what's happened here is in this particular one, you see the market kind of pushing up. Let me see if I can zoom in. There we go. Look at that. Can you see that better? So I just can't use the pointer now because when I point, it moves everything. So you can see right in the middle there, as the markets hit that first level, pulled back, a significant amount, and consolidated for a bit, and then started making another bullish move. The short-term traders are already long at that point, right? So when the market breaks that level, it'll knock out a couple of stops, but generally there's not a lot of buying left behind it, and that's where you get that little period of exhaustion. Market pulls back. So should you be the trader buying the market, down at the bottom and expecting that move? Maybe. But that can also be 50-50, right? Because you could say, well, shouldn't I be the guy getting short, expecting the market to move down to the lower level? Yeah, you're right. It's a bit of a 50-50 trade down there. But people do it. Now, with this false break, you're getting people that are taking money out of the market, not getting into the market, if that makes sense. I'll get rid of the zoom. Okay. Now, what happens when you've got a market that consolidates near that level as opposed to pulls back? When that market does break that, and it always does, it does test that level, sees what's going to happen, sees what orders are going to come into the market. When it does break that level, it'll trigger new orders into the market, and that's what tends to push it through. So that's when you see your things like your, I'm thinking of the right pattern, the ascending wedge, ascending triangle, descending triangle, the one with the horizontal line. So those kind of patterns tend to trigger new people getting into the market, where this type of pattern, this type of break, I should say, is false because people are getting out of the market at this time, if that makes sense. Taking profits from down below or that kind of thing, or even breaking even, or scratching a trade when the market kind of doesn't continue, pulls back a little bit. Well, I'll just get short now. Now the trick to trading these is not only recognize when there's a potential false break about to happen, insofar as like I just said, markets kind of run up to a level, pulled back and consolidated, or done something else not right at that level for a while. Now that's point number one. That's when you start thinking, when you start seeing a run up again, I suppose part 3 of the pattern. When you start seeing that run up again, you're not waiting until that break until you try and get into the market. What we teach in prop is you're stacking the book the whole day. You're adjusting your orders, you're canceling, you're putting new orders in. Why are you doing this? We call it stacking the book, insofar as you've got a lot of bids in the market, you've got a lot of offers in there. Why you don't expect to trade all of them. Now there is a rule in almost all markets I can think of, that any order must be placed within the intent to trade. That's not breaking that law. If you cancel an order, you are allowed to change your mind, but you're also allowed to grab Q position. So in a deep market, something like the S&P, and a market that doesn't move so quickly, Q position is really important. Q position means having an order in place in front of the next guy. So if you're waiting for that break and then you're going to put your little limit order in to sell, a lot of the time you'll end up upset because you won't get filled. So the trick is with these kind of things is to anticipate where the levels are going to be. Well, it's pretty simple because that first level is already there, right? And get your orders in, maybe an hour or 2 or 3 before the market even retests that. We're looking here at, what are we looking at? 4-hour charts, so there you go. That level there, 1, 2, 3, 4, 5, 6, 7, 28 hours later is retested. Over here, where are we? We're on a 15-minute chart, I think. Oops, so let me just get rid of these. Get rid of all those lines, get my pointer back. Okay, 15-minute chart here on the ether. So you can see these false breaks here, 1, 2, 3, 4, 5, hour and a half, that kind of thing later. So when you're actively scalping, or even very short-term kind of swing trading, and trading with your depth of market and order flow, you're getting your orders in well before the market even thinks about testing those levels, right? Because you get good Q position, and if the market breaks by 1 point, 2 points, you're filled. Right? So that's the second important part of trading these patterns, is to make sure you've got your Q position right. Now, what else we need to talk about? I want to have a look at the S&P as well. I think that's a good one to look at. You see that? Okay, yeah. Again, what are we on? A 15-minute chart here. We got my little squiggle drawer back again. No, I want a straight line, not a crooked one. All right, okay. Nice little one there. One's not there. That would have you stopped out. I would definitely have you stopped out. We see any others here? Not really. Oh, there. What's wrong with that? This one over here. Okay, 15-minute charts here. What you find? Let me get rid of those and scroll back a bit. Pardon me. Check it out. This beautiful one right here. I'm not talking about this little cluster here. Again, I'll zoom in. Little button that zooms. Yep. No, I don't have a button that zooms. All right, zoom. All right. Hopefully you can see that. I'm not talking that absolute low there on the chart. I'm talking that little low beforehand. That's enough to give you a decent little trade. Now, S&P, what else have we got? Let's get rid of that. Thing. Pointer, there we go. So you can see along here, you probably look at these, on a 5-minute chart and on the smaller time scale, a nice little one there. Not there. Now, generally speaking, again, I think it's crucial to be looking for that pullback, before you consider, or you expect it to be a false break, or see there's a chance of it to be a false break, I should say. Again, get your Q position in. Now, stops, that's a really important part. So something like the ASX 200 index, you would put in your orders 1 or 2 ticks above and put your stop 2, maybe 3, or 1 or 2 ticks above that. So very little. You're expecting these very small moves. Straight away when you get filled, or you're close to getting filled, you're putting your buy orders back in to get that Q position, right? So you're not placing orders when you're wanting to trade, you're placing orders ahead of time, if that makes sense. That's crucial to this kind of pattern. Now, in terms of stops, the thing about getting filled is, I've always said, you'll sometimes get filled on the great trades, on the great potential trades, but you'll always get filled on the bad ones. And it's particularly true when you're going against the market, which is what trading a false break is. It's a contrarian kind of trade. So you'll always get filled. Why? Because the market is just going to keep going through. It's not going to be a false break. It will be a break. So there's an absolute guarantee you'll always get filled on the bad trades. Now, so you have to be mindful of stops. Now, one thing we came up with as a potential stop is to have, you really need to adjust for volatility, right? So with something like the ASX, as I mentioned, 1, 2, 3 at the most tick stops for that market. Treasury bonds, probably the same. T-note, T-bond, the same. You probably go maybe a little wider sometimes for the 5-year note, probably not. But if you're trading NASDAQ, definitely wider. You're trading any one of these coins, look at Ether. Let's go back to Ether. and look for a look for this not textbook beautiful false break right here. That high there is 26.42, and that high there is 26.47. That's a pretty tight little move. Again, that's a 15-minute chart, but if we're looking at something like this, you know, that you probably got $50 there or something like that. High 49. No, it's a bit much less actually. But again, depending on your, you know, that something like ETH is never going to work with a 1 tick or 2 tick stop. If you're trading on 15-minute charts, you may be looking at a 20 to 30 tick stop. How do you work that out, right? Pull that number out of the air? Not really. Start with using an indicator. You need an indicator for volatility. I like the average true range, always have. I think it's a great indicator for more than just looking at the average true range. It's essentially a measure of volatility. If you're not familiar with it, essentially it measures the range on a particular bar and takes into account any difference between the previous close from the previous bar. So I was going to say previous day, but it doesn't have to be. It can be any bar period. So it essentially is it's measuring the range. It takes into account any gaps from the previous bar. That's called the true range, and then it averages that out. That's called the average true range. A great measure of volatility, great measure. We use it also to calculate hedge ratios when you're spreading and that type of stuff too. I think it's a really good thing to use for that. Sometimes better than the traditional ways of doing it. That's another video again. So with something like the with a false break, you want to be looking at, me personally, I think minimum 1 average true range as a stop. So if we were looking at something like this, can we see that? I'm going to zoom in again. No, I'm not, because I need my cursor. This move here, I'll draw a little box around it. Again, apologies if you're looking at this on your mobile, you're not going to see what we're talking about so much. Let's say we're looking at this group of trades here, this area here. Go back to my line here. I've marked out this level here. I've seen it approach. It's failed from there. First time it didn't do it. Second time it didn't do it. And third time it kind of did. Only for a little while. Let's say I saw this as a potential place to place a sell order to get short. I place my order up here. So in the lead up to this bar, I'm going to look at the bar before it, which is here. Take the average true range from there. Oh, you can see it's been 20 to 25 roughly that whole time. Higher earlier. Let's call it 30 points. Right. So at that point, with this particular trade, you would place a 30-point stop. Might be a bit wide. Common sense rules apply. But as I said, that's a great place. I think the average true range is a great place to start for looking at stop levels. So if we were to place a 30-point stop on this level here, where are we? 26.50, 26. Well, it's well above. It's well above, and it gives you plenty of room. Even eyeballing that chart, it tells you that it's probably a little bit too wide. But again, it's a place to start, right? So look, have a look. I suggest going away and having a look at a few different charts. Call up your average true range, and get your little pencil out and draw lines. Go a bit mad, and start having a look at how often these false breaks happen. Have a look at the average true range and see if a single average true range is a good stop, or maybe it might be half. But it gives you an idea. It's not exactly systemizing it, but it makes the whole process a bit of less of a decide at the time kind of thing. Your rough rules. You're trading a potential false break. You know that your stop is say 0.8 times of an ATR, and you know that if you do that, then well, it's worked in the past, and so on and so on. Also, just watch out for that consolidation. As I said, you don't want a market consolidating near that previous resistance or support. You want it to pull away and then come back again and have another go and have a little run up. So by the time it reaches, I should have mentioned before, I didn't even mention it, by the time it reaches that level, in some people's eyes, it'll be overbought or oversold. So, and that again gives it another reason to pull back and make it a false break. So anyway, let's wrap it up now. I've been rambling on for too long. I hope you got something out of that. Let's move to little credits page. You can't really see that page. Let's change the background. All right. So there's 3 things to do from here. I hope you like these little graphics that I'm doing as well. Believe it or not, they took forever to do. I thought I'd just do a bunch of slides that have some, trading terms and a few different technical things and that kind of stuff. I've got about 80. I'll put them all in other videos when I do other videos. But listen, there's 3 things to do from here. Make sure you subscribe and like the videos. Also, if you want a little bit more, if you want to jump on my email list, I will not spam you. You'll probably hear from me every month or maybe less. I don't know, when I get around to sending an email. Go to tradarian.com and there's a little form there. You can add your email. And if you really want to beef up your trading, again, at tradarian.com, you'll see a link to my advanced trading courses at masterclasstrader.com. I have my flagship course on trading with depth of market and order flow and scalping is there, and also my advanced spread trading course, my super advanced course, which I like. I love that course. I love the stuff we cover there. So anyway, check that out. Until then, trade well, be safe, and see you in the next one.